Most traders would have sought the very first reaction from this supply zone and expected price to drop immediately. But instead of collapsing, price pushed even higher into the same zone before the real bearish move began. So was the supply zone actually failing? Or was smart money setting a trap for both early sellers and late buyers? Let me show you what was really happening behind this move. Before looking for any sell setup, I first want to understand who is controlling the market. Here, price gave us a clear break of structure to the downside, which tells me that buyers are no longer in control and sellers are beginning to take over. Once this bearish break of structure formed, my focus shifted completely. Instead of looking for buying opportunities, I started waiting for price to retrace into a premium area where a potential sell setup could develop. After the break of structure, price begins retracing back into this supply zone. Now, this is the area that immediately catches my attention, because I'm already holding a bearish bias from the structure break. Instead of chasing the market lower, I prefer to let price come back into an area where sellers may become active again. This supply zone represents a premium area in the market, where smart money could potentially look to distribute positions before continuing the bearish move. So at this stage, I'm not looking for an entry yet. I'm simply waiting to see how price behaves once it reaches this zone. This is where most traders make a costly mistake. As soon as price enters the supply zone and shows the first sign of rejection, they immediately jump into a sell position. They believe the market is about to collapse without waiting for any additional confirmation. But the market does not always move the way retail traders expect. Sometimes, smart money has a different objective before the real move begins. So stay with me until the end, because the biggest lesson on this chart has not happened yet, and understanding it could completely change how you view a second push into a supply zone. Before price reached the supply zone, it created this inducement. At first glance, it looks like the market is gaining bullish strength, which encourages many traders to start buying. But from a smart money perspective, this area is important because it contains liquidity. The more traders that become confident in higher prices, the more liquidity becomes available. And as you'll see later, that liquidity plays a major role in what happens next. Before price reached the supply zone, it first traded into this Buy Side Liquidity area. This is an important clue because liquidity is often resting above previous highs. Many traders place their stop losses above these highs, while others enter buy positions expecting the market to continue moving higher. As price moves into this area, that liquidity becomes available for smart money to interact with. And once that buy-side liquidity has been collected, I become much more interested in looking for bearish opportunities rather than expecting the market to continue higher. This is one of the reasons why I was paying close attention to the supply zone afterward. Eventually, price reaches the supply zone and immediately shows a reaction. At this moment, many traders feel confident that the bearish move has already begun. After all, price entered the zone, sellers appeared, and the market started rejecting from the area. This looks exactly like the move they were waiting for. But this is also where patience becomes important. Because even though the reaction is there, we still do not know whether smart money has finished collecting liquidity. And that is why I do not rush into conclusions based on the first touch alone. While most traders are focused on what is happening inside the supply zone, my attention is also on these lows. This is where Sell Side Liquidity is resting. At this stage, I'm not saying price will definitely reach those lows. But whenever I see liquidity resting below the market, I keep it in mind as a potential objective. Remember these lows, because they will become very important later in the trade. Instead of dropping aggressively from the first reaction, price starts moving higher once again into the same supply zone. This is the moment that confuses most traders. The traders who sold the first touch now have their stop losses resting above these highs. As price pushes deeper into the zone, those stop losses begin getting targeted, forcing many early sellers out of their positions. At the same time, the move higher attracts additional buyers who believe the market is breaking out. To most traders, this looks bullish, but in reality, smart money may simply be gathering more liquidity before revealing the market's true direction. And this is the moment I was waiting for. After pushing higher into the supply zone and collecting liquidity, price finally reveals its true intention. Instead of continuing higher, the market forms a clear market structure shift to the downside. This tells me that buyers are losing control and sellers are beginning to take over. Now I have more than just a supply zone reaction. I have actual confirmation that the market may be ready to continue in the bearish direction. After the market structure shift, price starts moving lower with strong bearish momentum. Notice how the market continues printing bearish candles one after another, showing that sellers remain in control. Every new bearish candle gives me more confidence that the market is accepting lower prices and moving toward its objective. At this point, I am not focused on predicting a reversal. I am focused on allowing the market to continue delivering toward the target I identified earlier. Now remember the mistake I mentioned earlier in the video. Most traders saw the first reaction from the supply zone and immediately entered a sell position. Then, when price started pushing higher into the same zone, they began doubting their analysis. Some traders closed their positions early. Some traders got stopped out above the highs, and others completely abandoned the setup because they believed the supply zone had failed. But now that we've seen the entire story unfold, we can understand what was really happening. The second push into the supply zone was not necessarily a sign of strength. It was a move that collected liquidity from multiple groups of traders. Early sellers had their stop losses resting above the highs. Breakout buyers were entering the market, expecting higher prices, and all of that liquidity became available before the bearish move continued. Remember those lows I pointed out earlier? The sell side liquidity resting beneath the market. That was the area I wanted to keep an eye on from the beginning. After the inducement formed, after the supply zone reaction, after the second push higher, and after the market structure shift confirmed bearish intent, price finally delivered toward that liquidity. This is why understanding the narrative behind the move is so important. Instead of reacting emotionally to every candle, we follow the story that the market is telling us. And on this chart, the story was simple. Liquidity was collected above the market, so price could eventually deliver into the liquidity resting below it. The lesson from this chart is not to sell every supply zone you see. The real lesson is to understand what smart money is doing inside that zone before committing to a trade. Sometimes the first reaction is not the entry. Sometimes the second push is not invalidation. And sometimes the move that looks bullish is actually the final step before a bearish delivery. If you found value in this breakdown, make sure to subscribe, and I'll see you in the next one.